Hey everyone, welcome back to Corporate Decoder. Today CNP just filed a Form 8K announcing a new debt offering, and I am seeing a couple of interesting points that matter for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is raising a significant amount of money through notes, and the terms reveal some key details about their financial flexibility and future obligations. CenterPoint Energy Incorporated, a major player in the utilities sector, has filed this Form 8K to let us know about a new material definitive agreement. This filing is essentially a heads up that the company is entering into something important, and in this case, it's about raising capital through debt. The specific event they are reporting is the entry into an underwriting agreement. This agreement is for a public offering of $700 million in junior subordinated notes. Think of these notes as a way for the company to borrow money, but with some special conditions attached because they are considered junior and subordinated. This offering is being made under their existing registration statement, which means they have already laid the groundwork with the SEC to sell securities. The offering is set to be made through Mizuho Securities, USA LLC, PNC Capital Markets LLC, Scotia Capital USA Inc. TD Securities, USA LLC, and Us Bancorp Investments Inc., acting as representatives for the underwriters. The date of this agreement is the 30th of July 2026. This is a crucial piece of information as it marks the official commitment to this debt issuance. So, CenterPoint Energy, the company we are looking at, is planning to issue these notes to raise a substantial amount of cash. Now, let's dive into what these notes actually mean for the company and its investors. These are going to be 6.400% fixed to fixed reset rate junior subordinated notes, Series E, due in 2058. That's a long time away, 2058. So these are long-term debt obligations. The junior subordinated part is really important here. It means that if the company were to run into financial trouble, the holders of these notes would get paid back only after other, more senior debt holders are fully repaid. The interest rate is set at 6.400% for the initial period, which runs until the 15th of August 2033. After that, the interest rate will reset every 5 years. This reset rate will be based on the 5-year Treasury rate plus a spread of 1.885%. However, there is a flaw, meaning the interest rate will not go below the initial 6.400%. This provides some protection for investors against falling interest rates, but also limits potential upside if rates soar. A really interesting feature of these notes is the company's option to defer interest payments. Under certain conditions, CenterPoint Energy can choose to skip interest payments for periods of up to 20 semi-annual periods. This is a significant flexibility for the company, allowing them to conserve cash during tough times. But here is the catch. If they decide to defer interest payments, there are restrictions on what else the company can do. They cannot pay dividends on their stock, buy back shares, or make payments on other debt that ranks the same or lower than these notes. This shows how the company is balancing its need for flexibility with its obligations to different classes of capital providers. This is a common strategy for utilities to manage their capital structure, especially given their often stable but capital-intensive operations. By issuing these junior subordinated notes, CenterPoint Energy is effectively strengthening its balance sheet and securing funds for its operations or future investments while managing the cost of that capital. It is worth noting that the underwriters themselves and their affiliates are engaged in various financial services. They have a history of doing business with CenterPoint Energy and have earned fees for those services. This is standard practice in the investment banking world. The filing also lists various exhibits, which are the actual legal documents detailing the terms of the underwriting agreement, the junior subordinated indenture, and the form of the supplemental indenture. These are the nitty-gritty details that lawyers and sophisticated investors would pore over. Essentially, this filing is about CenterPoint Energy securing a large chunk of funding through a long-term debt instrument with some specific provisions that allow for interest deferral. Looking at the broader context, CenterPoint Energy recently reported its second quarter earnings. Headlines from late July indicate that they beat earnings estimates and revenues improved year over. Some analysis also points to a premium valuation for their stock and scrutiny on their capital expenditures. This debt offering could be a move to fund those capital expenditures or to refinance existing debt. The company's stock, CNP, is trading around $42 with a market cap of about $27.7 billion. Major institutional holders like Capital Research, Global Investors, and T. Rowe Price have significant stakes. This new debt issuance could impact their financial leverage ratios and overall risk profile. The fact that they have the option to defer interest payments is a significant point. It means that if they face unexpected operational challenges or need to prioritize cash for essential services or essential capital projects, they have a mechanism to do so without immediately defaulting on this specific debt. However, it also signals that this debt is subordinate. meaning it is a higher risk for those investors compared to the company's senior debt. In summary, CenterPoint Energy is raising $700 million in junior subordinated notes. The key takeaways are the long maturity, the reset rate feature with a floor, and the significant flexibility to defer interest payments. This move helps them secure long-term funding, but also highlights the subordinate nature of this debt, meaning it carries more risk. The company is clearly managing its capital structure to ensure operational flexibility and fund its long-term strategy. The success of this offering will depend on investor appetite for yield and their comfort with the specific terms, especially the deferral feature. The risk I am watching is how often CenterPoint Energy might actually utilize the interest deferral option. If they do it frequently, it could be a sign of underlying financial stress, even though it is technically allowed by the terms of the notes. What I am actually looking for is a clear path to how these funds will be deployed to generate returns that outweigh the cost of this debt. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.